Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will turn to the Australian dollar. The Aussie dollar has basically outperformed its major counterparts on both a 1 month as well as a 3 month look back basis, and there's plenty of reasons for the recent upside. However, there's both positive and negative catalysts in play for the Aussie dollar at the moment, and any one of them can basically tip the scale to further upside or see some potential downside. So join me now in today's video to see exactly what has been driving the Aussie dollar recently, what upcoming events we have this week, and how we can potentially trade the Aussie dollar based on those particular catalysts in this upcoming week. Now, the Aussie dollar has been the topic of much discussion in the macro trading community recently due to its resilience in the face of growing negative catalyst. Now, by looking at the chart below, we can see that the Aussie has outperformed its major peers on both a 1 month and a 3 month basis. And we're comparing it to a basket of major and emerging market currencies against the US dollar. We can see a very clear picture of that impressive strength in the Aussie dollar since the mid-March market crash. Now, the big head scratcher here is why the Aussie dollar has been so resilient despite the country heading for its first recession in 3 decades and possibly the biggest contraction the country has seen in almost a century. Now, that shouldn't really be a surprise to most people as the entire world is currently facing horrific downturns, and the biggest head scratcher for the Aussie is why it's been so resilient in the face of a mixed bag of both positive and negative catalysts. Now, starting with the economic data, it's been the least impactful point for the Aussie recently. Even though the economic data has been bad, the market has had to rely on mainly forward-looking indicators due to the quarterly frequency of Tier 1 data coming out of Australia. Recent PMI data, according to the Commonwealth Bank Flash Composite, has shown 2 consecutive readings, one of 21.7 in April and 26.4 in May. Now, these data points are concerning, but not too different from any of the other major economies due to the strict lockdown restrictions we've seen. So employment numbers, another one, broke records, not in a good way, of course. Job losses close to 600,000, unemployment rate rising to 6.2. Now, the bad data is said to continue, with some economists actually doubting whether the reopening of the economy will see any type of rapid recovery in terms of the labor market. Now, to try and offset some of these negatives, we have seen the government pledging to spend 130 billion over a 6-month period to try and basically save as many jobs as they can. And we also had the central bank cutting rates down to 0.25% and starting a bond buying program with the aim of yield curve control, keeping the 3-year yield at 0.25%. Now, the spending wasn't only good for consumers, it was a little bit bad in terms of its rating, with Fitch downgrading Australia's AAA credit rating to negative due to fears that the spending will basically cause large fiscal deficits and, of course, see a big jump in terms of debt to GDP. And between the government and central bank, the total fiscal and monetary stimulus measures way up to about 16.4% of GDP. So massive stimulus going on. Now, the rise and fall of recent consumer confidence numbers shows that we had that outright panic as the virus hit, but we also had a rebound as those stimulus pledges started to come in, and of course the economy started to reopen. Now, the country's battle against the virus has been one of the more optimistic points for both consumers as well as investors, and due to the country's early response, they have been able to exit the lockdown earlier compared to the rest of the world. New cases as well as fatalities are some of the lowest in the world, and basically the fear of second wave infections and reopening stresses is much lower in Australia compared to other places like the US and Europe. Now, in line with that reopening activity is also China. The country where all of the devastating virus originated from is starting to show some signs of recovery, as they were the first economy to basically come out of those restrictions. So why is this significant for Australia? Because China is Australia's biggest trading partner, with over 35% of total exports going to China alone. Now, usually that would be a good thing, but recent political issues have caused some worries to emerge. Now, China has been known previously to punish countries in retaliation of political tensions. We had countries like South Korea, Japan, Taiwan, and Canada all suffering economic pain as China resorted to economic measures to retaliate against political differences. Now, unfortunately, it seems that Australia has now become a new target due to Australia calling for an independent investigation into the origins and the spread of the coronavirus. Now, in the past few weeks alone, China has already banned meat imports from 4 important Australian abattoirs and also slapped 80% of import tariffs on Australian barley. Apart from that, China has also said to be considering targeting Australian wine, dairy, seafood, and oatmeal products as well. Now, given the size of these exports, they will of course hurt the economy, but China might only be warming up with these type of products, as there were rumors claiming that 5 major state-owned Chinese utilities were directed to stop buying Australian coal, and other rumors that China might be banning Australian thermal coal. Now, if that is true, the implications could be devastating for Australia, as coal comprises almost 20% of total exports, of which 82% of that alone is exported to China. Thus, this developing story is one that will be very important for the future outlook for Australia, and is one that is arguably not really been priced into the market as yet. Then, as if tensions between China and Australia wasn't bad enough, we've also had further brewing tensions between the US and China, talks of possible sanctions, possible eventual military confrontations, and Hong Kong were just some of the developments that Aussie traders had to deal with recently. However, after Friday's more, let's call it timid response from President Trump, there might be some scope for possible de-escalation, but we will touch on that a little bit later. Sticking with Australian exports, going to iron ore. Iron ore has seen a massive move to the upside, breaking that $100 barrel or $100 per ton level. And the reason for that has been basically China's economy starting to show signs of recovery, which obviously leads to more iron ore demand. And at the same time, we've had some supply issues coming from Brazil in terms of the coronavirus, and that have seen a big surge in oil prices and has been supportive for the Australian economy. Now, apart from iron ore, apart from all of the other metrics, the biggest positive driver arguably for the Aussie dollar has been the equity markets, more specifically the very bubbling US equity rally that we've seen since the mid-March crash. Now, to prove this with just a quick chart, we've basically overlaid the S&P 500 with the Aussie US dollar as well as the Aussie yen. Now, without cheating and looking at your charts, can you tell me which one is which? Now, if you couldn't, that is exactly the point. We can see that very strong correlation between the Aussie dollar, obviously as a risk proxy. It has been enjoying lots of upside alongside the US equity markets. And just quickly, by the way, the S&P 500 was in blue. We have the Aussie US dollar in gold, and of course the Aussie yen we can see in red. So even with all the positive and negative catalysts currently in play, arguably the biggest driver for the Aussie dollar has been the FOMO-driven rally in US equities that we've seen to the upside. And the big question now is, can the equity rally last? And if so, will the positive Aussie catalysts be enough to basically outweigh the negatives in both the short and the medium term? Now, turning to the week ahead, there's a couple of things we need to keep on our radar for the Aussie dollar. Domestically, we have the RBA policy meeting coming up on Tuesday. Now, in response to the pandemic, the RBA has already cut interest rates down to 0.25% and also started its very first QE program. Now, unlike most QE programs, the bank has opted for a bond buying scheme that basically primarily focuses on yield curve control. So it's not a QE program in the more traditional sense. The bank's basically purchasing bonds with the sole aim of keeping 3-year bond yields at 0.25%. Now, there's been some speculation of the recent tapering by the RBA of their bond buying program, but the bank has succeeded in basically keeping that 3-year yields on target. And that will obviously naturally cause them to taper some of those purchases as they move closer and away from that target range. Now, in this week's meeting, the market is expecting the bank to stick to the script and it's not anticipating any new major announcements. Now, the bank, especially Governor Lowe, usually opts for a more optimistic outlook and tone, and that might see some more reiteration of the more recent positive comments we've had from them. Now, we also have the release of Q1 GDP. Now, consensus expects a quarterly number of negative 0.3% and year-over-year number to come in at 1.4. Now, this is very different compared to some of the second estimates of US GDP for Q1 coming in at negative 5%. And according to analysts, a big offset for Q1 was the massive jump in panic buying, which basically supported growth from the more retail sector. However, as with most Q1 data from around the world, the big focus will be on Q2 data, as it will fully encompass the blow to economic activity during the lockdown. Turning to international things, we need to keep a very close eye on further developments between China and Australia. Any further comments from China banning more products from Australia will be an important driver in the short term, especially if it's relating to those main products like iron ore and coal. We also need to keep track of the ongoing US and China tensions. On Friday, we had President Trump delivering a press conference, which was certainly milder than some market participants were expecting. And even though negative rhetoric emanated from the speech, the actual actions taken against China in retaliation to Hong Kong and other matters were on the softer side. And the speech was a light slap on the wrist and did give equity markets a reason for a late week rally into the close. So how China decides to respond this week will be important, and whether the US administration shows more teeth this week will be very important considerations for the Aussie dollar. Of course, apart from that, overall market sentiment and commodity prices will also be in focus. Then turning to possible sentiment shifts, starting with the hawkish ones, US-Australia tensions. Now, the retaliation from China against Australia has so far only included barley and meat products from 4 abattoirs. If the situation inflation calms down and we see China scaling back those threats, especially for other products like coal, we could see some potential more upside for the Aussie. So we need to look out for any possible news saying that China has decided against further tariffs or import bans on additional products. And even if we just see them really putting forth any new comments, that can also prove more positive on balance for the Aussie. Turning to US-China tensions, after President Trump's speech on Friday, there is scope for some de-escalation between the two sides. So if we see a more timid and lighter response from the two sides this week, that should also give risk assets another reason to continue the rally. And of course, that should support the Aussie dollar. Turning to the RBA and the data, now the RBA has a tendency to be more hawkish than markets are often expecting. Recent comments from Governor Lowe also suggest that the bank thinks the economic fallout might be slightly less severe than previously anticipated. And if the bank's tone is more hawkish than expected, then, and that is also coupled with a possible better than expected Q1 GDP, that can of course also provide some upside for the Aussie. Turning to Brazil and iron ore, keep a very close eye on Brazil with regards to the coronavirus and how that affects iron ore supply. The pandemic fallout in the country has sparked concerns about Brazil's iron ore supply, and a drastic escalation in confirmed cases in the country could spark further supply fears, and of course that should see a rise in iron ore prices, which should be more supportive for the Aussie. Turning to dovish sentiment shifts, again, US-Australia tensions. If we see a confirmation of the rumors that China is planning to ban Australian thermal coal, then that can really hurt the Aussie this week. Even in the midst of a risk rally, that can also see some downside, so pay attention. If the main exports become their next target, the downside could be exacerbated and is something we need to keep track of. Also then, US-China tensions. The US administration came across very timid on Friday, and if they are to correct this softer stance this week and come through with larger and more severe retaliation measures, the Aussie will feel some pain. Also consider that China still needs to respond to Friday, and the wrong type of comment might see further US actions. Just keep in mind though that US elections is 6 months away, so some analysts are expecting US administration, especially President Trump, to take things slightly more easy towards China in the next few months. Then turning to the RBA and the data, markets aren't really expecting anything new from the RBA this week, and given their regular demeanor, they will probably lean more to the optimistic side. However, the Aussie dollar has seen lots of appreciation, and a stronger Aussie, especially compared to some of the other more major currencies around the world, can't be something that the RBA is too excited about. So we might be seeing some more jawboning coming from the RBA, trying to keep the Aussie dollar from appreciating too much. Always a risk we need to consider. And then turning to commodities and equities, recent risk rallies in the US equities and things like iron ore has been key drivers for the Aussie. So a drastic change in the short-term performance of any of these two will have drastic negative changes for the Aussie as well. So definitely something that we need to keep in mind. Then possible currencies we can pair in the case of sentiment shifts. We will need to establish whether sentiment shifts in the Aussie is due to risk sentiment or due to other factors to make the best pairing decisions. If we see a dovish tone in the Aussie and it is led by a negative risk tone in the market, we could look for some Aussie yen or Aussie US dollar downside. And if we have a dovish shift on the Aussie, overall sentiment is more mixed. We could pair it against the euro if we have further positive progress with regards to the EU recovery fund. If we have a hawkish tone in the Aussie and it is led by a positive risk tone, we could look for some Aussie yen and Aussie dollar upside. If we have a hawkish shift but the overall market sentiment is mixed, we could pair it against the pound, especially if we have more negative Brexit developments. Remember that these recommendations are obviously based on the current fundamental bias for these currencies and can change throughout the week, so make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Then turning to possible economic news we can trade into this week, we do have important scheduled events lined up like the RBA and Q1 GDP, but in the current context these events will not be as important to the Aussie as the overall risk tones as well as the US-China and China-Australia tensions. Thus, we won't really be looking to trade into any of these upcoming scheduled events this week.